What decision has most Americans made which resulted in a better lot in life for these Americans? And in some cases, the decision led to wealth and their financial independence. That decision was purchasing a home. What is the critical factor about purchasing a home? Is securing a loan. That's what we're talking about today with a very successful loan officer in the Los Angeles County area. When we come back, we'll be interviewing him and talking to him about how you can get into a home. So we're here with a very successful loan officer in the Los Angeles County area. He has closed and or originated more than 1,900 loans. That's a lot of loans, that's a lot of families, and that's a lot of success. When we come back, we're going to talk to Armando Gonzalez about how he did this for those families and how he could do it for you as well. We are back with Armando Gonzalez, who is a prominent loan originator, in my opinion. He's assisted a lot of my customers, and all of my customers have been very happy with his services. Armando, tell us a little bit about yourself and how you got involved in the mortgage origination business.
Well, let's see, Daryl, how I got involved in the real estate business. Back in '89, I obtained my real estate license. However, I had a young family, and so I needed a more steady income coming in. I got involved with working with Mr. Bill Chris as his assistant originally. I then worked with him for a couple of years, assisting him, learning the real estate business, the lending side of it. I then went on to become my own self-independent. I since then have helped over 1,900 families, the majority of them being first-time home buyers, people that didn't think they could actually buy a home, but that through my knowledge and through some of the down payment assistance programs available, we were able to help them get into their first home.
As I mentioned earlier, Armando, we were talking, I've assisted a lot of buyers, and as a brand new agent myself, people didn't realize, or buyer prospects didn't realize, that you could be employed at McDonald's and still assist in qualifying for a home. What kind of job would one have where they cannot use that employment or that job to assist in qualifying for a mortgage?
Well, Daryl, here's the thing with employment. When you're buying a home, the lender is interested in knowing what you've been up to for the last 2 years. So regardless, if you have been working at McDonald's or Burger King or any other job for that matter, as long as you are able to document the income for 2 years, we can use it. Now, if you have been paid cash under the table, now that's a different conversation. However, any type of employment, self-employment, McDonald's, any type of job, as long as we can document it for the last 2 years, you're definitely able to purchase a home.
Okay.
Yeah.
Okay. So is there a number of people that cannot go together in purchasing a home? Meaning, if 6 or 7 people got together and it's a 4-bedroom house, can they pool their resources together and still purchase a home?
Well, here's the thing. Back in the olden days when I first started in this business, you could have as many as you needed as far as borrowers, co-borrowers in the file. However, nowadays it's limited to 4. So we are limited to 4 spaces on the application in order to still be within the system ability to withstand. So four is the max, 4 borrowers.
Okay.
But if you have husband and wife, and then they have 2 grown kids that will help, or if you have 4 siblings, they can all go in, buy together. That we're talking because in case we don't have enough income from 1 or 2 people, if we need to pool everybody's income to be able to qualify for the home loan, definitely possible, as many as 4.
Okay. So is there an age limit for someone that is a co-borrower? Let's say you have a minor child that's I guess if you're 17 or 18, 17, can you work at 17?
You may be able to work, but in California, you're not allowed to purchase a home until you're 18 or older.
Okay.
So as far as the age of the applicant, they do need to be 18.
Okay.
Yeah.
And so if that applicant is 18 years old, do they need a 2-year work history? So that means they have to be at least 20 years old.
Correct. They do need 2 years worth of employment, but some high school people work summer jobs, and if they carry through and we can document 2 full years of employment, we can still do it, even if they're only 19.
So what are the main guidelines in terms of qualifying? A person needs a 2-year work history. They need what kind of credit score?
Okay, so let's talk about that. So when you're applying for a home loan, there are 3 main components. One being the employment, we have already established 2-year employment history, and then the credit history. Now, when it comes to conventional loans, you are required to have a slightly higher FICO score. The higher, the better the pricing, but the minimum for a conventional loan is 620. So you must have at least a 620 FICO score. When it comes to FHA, you could do it as low as 585. So they're a little bit more lenient. They're also a lot more lenient on the ratios. So let's recap here. So there are 3 main ingredients, 3 main criteria for applying for a home loan. You have got your employment, you have got your assets, and you have got your credit.
What are the main costs or the expenses of buying a home? What do buyers need to prepare themselves for?
Okay, Daryl, so what are the main expenses of purchasing a home? There are 3 separate ones. You have your down payment, which could be as little as 3%, and then as high as you would like and have the ability to, but as little as 3%. Now, when you purchase a home, there are going to be some expenses. One, it's called that non-recurring closing cost. What does that mean? So when you buy a home, you're hiring a lender, you're hiring an escrow company, you're hiring a title company, an appraiser, notary, recording. Those are called the non-recurring. Just like the word says, non-recurring. They only happen one time. So when you're buying, you will have those. And then there's a third expense. There's the reoccurring closing cost. What are those? So when you purchase a home, you have to pay for the first year of insurance right at the closing. And then there is also an impounding of your property taxes, which could be as little as 3 months, but as much as 6 at times, depending on when you're closing.
Now, what's the impounding of it? Most people that are brand new, they really don't know what's going on when you say the impounding of it.
Okay, so let's talk about that. So when you purchase a home, when you make your payment is made up of 4 items, which is the principal and interest. That's what pays for the loan. That's what pays the lender back. And then you have your property tax, and then you have the insurance. So you're paying on a monthly basis. So the lender needs to impound, which means that they need to establish an account that saves month to month enough in that account so that when the taxes become due, they get paid straight out of there. When the insurance becomes due, it gets paid right out of there. And so you don't have to worry about your property tax or insurance because it's being impounded. It's being put into that account on your behalf and paid when it's due by the lender.
Right.
Making it to where all you have to worry about is making your monthly payment, and you have to be conscious that your payment includes the principal and interest, tax, and insurance, which takes care of everything.
It's similar to your car being impounded, where the police will take your car and put it somewhere, right?
Exactly the same process.
Okay.
Exactly the same.
Yes, but what they do is they take 1/12 of whatever that expense is and set it aside. So when it comes due, that being the property taxes and or your insurance, they will pay it at that
the
time.
The lender pays it on your behalf from your own funds.
Okay.
Yeah.
Now, do lenders require an impound account from all borrowers?
Okay, so if you're buying under FHA or VA, it's automatically 100% required. If you're buying under conventional and you're coming in with a low down payment, it's required.
Okay.
If you're coming in conventional with 20% or larger down, then it's optional. You decide if you want to pay your own property tax or own insurance. Now, let's keep in mind, a lot of people feel better that they pay their own taxes and insurance, meaning that they don't want to have an impound account, and that's all right. But here's the thing, and a lot of people believe that having an impound account, paying your property tax and insurance included with the payment, it's going to cost you more, but in reality, it is not. The lender isn't going to charge you for making those payments on your behalf. That's just part of the servicing of the loan. There's a myth out there in the world that people believe, oh, I better just pay my own tax and insurance because otherwise it's going to cost me more and more interest, more this, more that. But it isn't. That's not accurate. The payment, it's collected every month, set aside for you, and paid on your behalf. It does not cost you any more or any less than if you pay yourself. But if you're going with 20% down or larger down payment, it's entirely up to you if you want to have it impounded or if you want to pay your own. It's up to you.
Okay. So, folks that are watching us, the folks that are still with us, are probably thinking about buying a house. What should they start doing right now in order to prepare themselves before they even come talk to you? What should they know?
So, they're always welcome to come to us because we're the professional. We do this every day. And a lot of people that we talk to and meet with, we actually look at their situation and then send them home with a little bit of homework. Like, work on this, do that. But here, just like I said earlier, the main three components of a home loan is, have you been employed for 2 years? You check. Yeah, I have. Okay, you're good in that arena. How is your credit? You have no idea, but have you been using credit? You have student loan. Are you somewhat confident that your credit is in good standing? Should you think that it may not be, you can come to us. We can take a look. If we determine that your FICO is not high enough, there are certain things you should do, we will make recommendations. For example, some people have credit cards that, the max credit is $1,000 and they of course owe $800, and then we retrieve the credit and then the FICO comes in rather low. Well, one thing that is very easy to fix and that helps and works every time is pay down your current balance. Let's just say that your max credit is $1,000. That account should always be kept at $300 or less. 30%, that's the key thing. If you have 30% or less of your credit used, it'll work in your favor. Now, if you are exceeding that 30%, it's just as simple as paying it down to that level. And then the next time they report, it'll increase. Your FICO will increase. Now, if you haven't got a lot of credit established, or any for that matter, it may be a good time for you to get started by either applying for some credit cards or, and some people feel that they're not going to get any because they don't have any history. There is such thing as getting a secured credit card. What that means is that you go to your local bank, most of them offer it. It's called secured credit card. What does that mean? It means that you come in, you set aside $500 or $1,000, however much you have available, into this little CD account, and then they use that account as collateral for the credit card. You still make your monthly payments, but the bank feels given that you haven't got any history, they will use that. In other words, your own funds are used as collateral, so if you were to default on it, they're already taken care of. But that's another way to get going. Most people will have some kind of credit, either student loans or even some places where you rent, they report. And then there's also such thing as self-reporting. Nowadays, you find a lot of people who self-report on their utilities, self-report on different things. So it's not that difficult to create a credit history and a FICO score. But if you're not sure, you can come to us. We can look at it and make some recommendations.
So off the top of your head, what would you consider insufficient amount of credit?
Yeah, so let's just say that all you have is just one credit card that you just recently opened. So that will probably not work in your favor on the beginning, because here are some of the factors that the FICO folks use to determine the FICO score. So the length of time that the account has been open, the proportion of the account, and also when you apply for a credit card or any kind of debt, the inquiry goes against your score. So if an account hasn't been open for longer than 2 years and it's exceeding the 30%, this is going to be not in your favor. So, if you have had accounts for at least 2 years and you try to keep them at 30% or less of the max, you'll be in good standing.
Isn't there a number of inquiries that you could have run before it will negatively impact your
Well,
credit?
that just depends, though. If they're real estate related, you can have as many as 5 within a 90-day period, and it's not going to affect your credit quite as much. However, if you have 5 inquiries in the last 90 days, but one of them is from the car dealership, the other one is from the store at the mall, and then the other one is real estate related, and then 2 others are for some other stuff, dental work, whatever, then that is different. That will work against you. But if they're all real estate related, they understand that when you're looking to purchase, you may be shopping around, you may be comparing. So that is allowed and it's not going to be as harmful. But it's best that you don't have too many, try to have as few inquiries as possible. But there's also a possibility to get one's credit score and credit report by going into some websites that they don't charge you, like annualcreditreport.com will give you one, and that one doesn't go in as
a consumer credit report.
It correct, but it doesn't give you a hard check, so therefore your FICO doesn't suffer. So if you want to start there, by all means. And then the other item is, of course, we have to make sure that you have the funds necessary. Now, some people think that all the money has got to be right in your account in order to make it possible. Well, FHA will allow you to get a gift from a relative. So let's just say your parents are willing to gift you a little bit of funds to complete the amount. You don't have to wait until you have had it in your bank account for a while. It is allowed. Under FHA, you can actually have a certain amount of money coming in from a relative. It does have to be from a blood relative, but it's allowed. Another way to do it is a lot of people have retirement accounts, IRAs, 401s. It is possible to borrow funds from there for the purchase of your home. So, and then there's also some down payment assistance programs that we can take advantage of. Now, once we get together, we can determine whether or not, you would be eligible. The majority of folks who have not owned in the last 3 years are eligible. Some people think that in order to be eligible for some of those programs, you need not have owned a home ever.
Right.
But that isn't true. The definition of a first-time home buyer is someone who has not owned a home in the previous 3 years. And so that's, if you have not owned a home in the last 3 years and you have a FICO score of at least 660, we definitely could inquire about some of those down payment assistance programs because that's their minimum. They do want a 660 FICO score.
How do mortgage lenders look at recent college graduates or people with some kind of advanced educational training? Do they still require a 2-year work history of those persons?
No, sir. If you went to school to become a doctor and you're practicing in that field, you can do it as soon as you get a permanent full-time position. And the same is true not just for a doctor. The same is true for a person who even just went to a technical school for 6-9 months.
Wow.
Some people...
I didn't know that.
Some people who... It's definitely true. I mean, I've done several loans for people who become CNAs. And you would think, they only went to school for 6-9 months and now you're able to purchase. You can use that license as long as your new position is permanent and full-time. Then you can definitely use it, even if you haven't been working for the last 2 years. Just like that, there are many other jobs that as long as you went to school to get your certification in that field, we definitely are able to use it and get you into that home.
Qualifying ratios and why are they are important to qualifying somebody. What are they?
Okay, so that's very important to keep in mind. So let's just say, so the lender has a criteria. The lender wants to use only a certain percentage of your income to go towards your housing because they understand that, 100% of your income, we have got to cap it at some point because you still have to pay for groceries, you have to pay utilities, you still have to pay for taxes, whatever else. So the lender will allow you to have as much as 45% of your gross income for your housing expense when it comes to FHA and conventional. Now, conventional, if you have a good credit history and you're doing at least a 5% down payment, in some cases will allow you to go up to 50% income to debt ratio, which means that 50% of your gross income could go towards your housing and your expenses.
Wow.
So what does that mean? You have a car note, you have a student loan, you have credit card. So that plus your new house payment, up to 50%. Now, FHA is a lot more liberal. So FHA says if you have car note and credit cards and things like that, we will allow you to have as much as 45% of your income for your housing expense, but up to 56% total, meaning your credit card, student loan, car note, anything else.
Other related debt.
Other debt, yeah. So FHA is a lot more understanding. You have to understand, FHA was created to house people. Conventional, it's definitely cut off at 50%. Even under the most qualified people, once you reach that 50%, that's like the cutoff point.
Yes, sir, Mr. Gonzalez. Let me ask you this here. Now, how important is it to be pre-approved or pre-qualified before you start looking for a home? But before you answer that, let me clarify something. What is the difference? Because a lot of people don't know between pre-qualification and a pre-approval of a mortgage.
Yes, they're a good question, excellent question. Being pre-approved or pre-qualified are completely different things. What one means, pre-qualified means that somebody just talked to you over the phone or looked at your situation in general and determined this, I can pre-qualify you. That's one thing.
Now, don't they have to run your credit report in order to pre-qualify you?
So see, that's the thing. A lot of people feel that if they run their credit, their FICO is going to suffer. So then now they just tell the loan rep, oh no, my FICO is 740. And then the loan rep pre-qualifies you based upon hearsay or your say.
Right.
So absolutely, my recommendation for everybody is to be pre-qualified, completely ready, pre-approved, pre-qualified, but in the whole sense that somebody other than just the loan rep has looked at the file. So when you actually get yourself in a position to where you get pre-approved, when you submit your offer, the realtor on the other side, it's going to be a lot more confident and more willing to work with you and accept your offer. So you're increasing your odds. So definitely very important. There's also a real important reason for doing that. And this, I believe, is the most important. Some people like to go out and look at a certain neighborhood, certain type of property, thinking that's where I want to live, that's where I want to buy. Perfect. However, if you actually meet with somebody like myself and get pre-approved, completely ready to go, this will give you such a good understanding of the process. It'll help you understand exactly what's going to be involved with the purchase. It'll help you understand what to expect payment-wise, what price range to be looking at. And not only that, but it'll increase your odds of getting your offer accepted, because when the offer is submitted and the other agent know that you have done all of this and you're completely ready, they're going to look at your offer in a much different light. So
without a doubt.
Definitely recommend it. Not just for increasing the odds of getting your offer accepted, but also for you to understand exactly what's involved, because that way you can make a more educated decision.
In order to be pre-approved, what kind of documentation can the borrower expect to be gathering and taking to the loan officer to be pre-approved?
Yeah, so when wanting to get yourself ready to submit offers and get pre-approved, there are three areas that the lender is going to want to document. We start with obviously the credit, so the lender will be checking that. And then you as the borrower, you have to submit your income tax for the last 2 years, your paycheck stubs for the last 30 days, and your banking statements for the last 2 months, proper identification, driver's license, resident card, whatever you want to provide, but proper. That's about the general number of things that are needed. Now, in certain scenarios, we may need additional documentation, but those are the basic things. You have to deal with showing where you've been employed for the last 2 years, and you do that by providing your income tax for 2 years, your paycheck stubs for 1 month's worth, which is typically 5, and then your banking statements 2 months, your ID. We're good to go.
Can you buy a house if you had a foreclosure or bankruptcy? And how does that work if you can?
Absolutely. You definitely are able to purchase the home after a bankruptcy or after a foreclosure. Now, depending on what type of loan you're applying for, there are some waiting periods that you have to adhere to. So, for example, FHA says that if the bankruptcy was for a reason way beyond your control, you could purchase the home in as little as 1 year's time.
Like medical supplies, maybe, or not supplies, but bills. Is that?
Medical bills is not one of them.
That's
but
not
if
one of them,
somebody
okay.
passed away or something, or for example, I have had people who have to file bankruptcy because their home was like a part of flooding,
Right,
like
right,
some
right.
stuff that is completely beyond
Natural
your control.
disaster or something.
Exactly.
Okay.
Then in that case, they'll allow you to do it 1 year later. Now, when it comes to conventional, they're a little bit stricter. So FHA guideline is 1 year if something completely beyond your control, and then 2 years if you could have controlled it. But as long as you wait the 2 full years, then you're good to go. Now, the lender does not want to be the first one to lend you after the bankruptcy. So you got to make sure that if you have filed for bankruptcy, you want to reestablish your credit just as soon as possible, because the lender does not wish to be the first one to lend you money.
They want to see some history.
They want to see that you have reestablished yourself.
Right.
Correct. Now, conventional is a little bit stricter when it comes to that. They want to wait 4 years. So, but FHA 2 years. So, with the foreclosure, the same. You have to wait 2 years for one and 4 for the other. So, definitely waiting periods, but that doesn't mean that you can never ever purchase again. You can, but you have to make sure that you wait the appropriate amount of time.
So how many years is it for bankruptcy do you have to wait?
2 years for FHA and 4 for conventional.
Okay. Okay. Okay.
And this is for agency, FHA, Fannie Mae, Freddie Mac guidelines. There are some loans out there, some lenders, that with a large down payment, they'll take a chance on you. Some say as little as, a month later, they'll do it. But it will require a much larger down, and the terms won't be as favorable, of course, because the risk is greater.
Also, Mr. Gonzalez, I've talked to several people who have mentioned to me that they previously filed a bankruptcy or they had a foreclosure, and they're not sure if they could ever buy a house again. Let us know about, can you buy a house if you had a foreclosure or bankruptcy, and how does that work if you can?
There are some other options, but if you're going to be dealing with agency, which means Fannie Mae, Freddie Mac, FHA, those are the waiting periods.
And they have questions that they want answered, and once they get those questions answered, they'll comfortably take some action. You have a problem with having any of these persons contact you and ask you questions and assist them in preparing themselves to get ready to buy a house?
Absolutely not. Quite the contrary. I encourage everybody to explore their options and make sure that they understand what they're getting into. Because if you're well informed and you have got all the information in your hand, you'll make a real good decision on your own. And I like to be able to help you, as I have helped so many other families. That's what I do, and I get a lot of satisfaction of helping people that otherwise couldn't make it happen for themselves. The other thing that we didn't talk about very much is there are some people who have the ability to obtain a co-signer, such as a parent or a relative or of some sort. They're able to make the payment, but they don't quite have the income to do it. So if you get a co-signer, it's still possible to purchase a home. So keep that in mind. But of course, the main thing is for you to make sure that you feel comfortable, that you can handle the payment. Because what we want to do is we want to be a blessing to you. We want you to buy your home, get in it, enjoy it, and of course, gain equity. You see, when I first started in this business, homes in the city of Norwalk, California, were $80,000, $90,000. Yes. Nowadays, they're $700,000, $800,000. Same home. So guess what? What that means is that if you kept that home, you have accumulated an enormous amount of equity that belongs to you. That otherwise, if you had been staying somewhere renting, you have paid the landlord's home. You have paid their mortgage. So definitely I would encourage you to explore the possibility of purchasing because not only does it help you in the long run by accumulating equity, but also check with your tax person, because owning a home does offer you tax benefits that are real, and they're different for every person. That's why I encourage you to talk to your tax person. But in general, home ownership, it helps you accumulate wealth. It creates a legacy for your family, and it helps you tax-wise throughout the life of the loan. So definitely find a way to explore the possibility of purchasing.
Do you have to be a U.S. citizen or have a social security number in order to qualify for a mortgage?
So all of the agency products, such as FHA, Fannie Mae, and Freddie Mac, will require you to be at least a legal resident, and in some cases you can have an employment authorization. There are certain types of employment authorizations that are eligible, not all of them. The Dream is one of them. Dreamers, they're eligible, and several others are, but not all. But for those type of loans, absolutely you have to have at least that. Now there are some, which means that you would have a social security number of your own. There are some loans which they call the I-10 loan, which means that you're not here legally.
Taxpayer identification number.
Correct. And there are loans for those type of folks still, but they're not through the agencies. They're, other lenders that have
alternative
created.
lenders.
Correct. So the terms are not as favorable, but at least there is an option.
Okay.
But in general, you are required to be at least a resident. Yes.
Okay. Are there any questions that I haven't asked you that you know that's really useful and important information that a first-time borrower or even a second-time borrower should know?
I think we have touched pretty much all the information that's needed. But if there's anything that we didn't cover, just feel free to call us. My phone number is 562-756-1477. And you text me or leave me a voicemail message. I'll for sure return your call or text.
Okay. Okay, sir, I want to thank you very much for coming on this program, sharing 30 years plus information of origination experience with you guys. Here, let me tell you guys something. I've worked with this man personally, and I could vouch for him. I would do that with anybody that asks me. I like honest, respectful people. I like being able to know that I can depend and trust what someone shares with me and tells me. And this gentleman is one of them that I can tell you that's been there for my family, my clients, my customers, and myself. So, and
I will do the same for every one of you. And if I take on your case and I'm able to, if I take on your case and I'm able to help you, I will do it with the best disposition. I have helped many families, and I get great satisfaction of helping people achieve the American dream. So give us the opportunity. We'll help you through it. It may not be that you're ready today, but if you're not and you still want to explore it, we'll look into it, give you some suggestions, and if you follow through, we'll get you there.
¿Sí habla español?
Por supuesto, le servimos a nuestro idioma.
Sí se puede.
Sí se puede.
All right, Armando. Thank you again, and we'll catch up with each other here in the future.
Thank you for having me. I look forward to being of assistance.
Stay right there.
Yes, thank you.